What do you call it when the world's most powerful economy starts bleeding $4 million in debt every single minute? Just as the one country keeping it afloat decides it's done playing along. Picture this. The United States enters the second quarter of 2025 expecting to find $850 billion in cash reserves. Instead, it opens the books and finds barely half. At that exact moment, China torches the dollar by unloading $1.7 trillion in U.S. Treasuries, sending shockwaves through the global financial system. With its fiscal cushion obliterated, Washington scrambles to borrow $514 billion just to keep the lights on, a spike of over 300% from earlier projections. Interest rates soar, inflation ignites, nervous allies pull their money, and suddenly the most trusted debt in the world starts looking radioactive. This wasn't a blip, it was a message. The old order is cracking. The U.S., already staggering under the weight of a deficit that balloons by over $4 million every 60 seconds, suddenly finds that weight doubling as China hits the eject button on its Treasury holdings. This was no random sell-off. It was a retaliatory strike, economic warfare disguised as a portfolio adjustment. The spark? A bold move from Washington to block major U.S. banks from underwriting the $5.3 billion IPO of CL, China's dominant EV battery giant, a firm with ties to strategic defense technologies. The Department of Defense labeled it part of China's military-industrial network. And under that shadow, J.P. Morgan and Bank of America were forced to walk away. The decision cost them more than just underwriting fees. According to Reuters, the loss of future access to China's financial ecosystem could stretch into the billions. But Beijing didn't just protest, it acted. And it acted globally. The numbers tell the real story. China cut its U.S. Treasury holdings down to $759 billion, the lowest in nearly a decade, while quietly ramping up its gold reserves for the fifth straight month to 2,292 tons, a clear sign of intent. This wasn't reactionary. It was a methodical pivot away from dollar dependence, a deliberate move to fortify its fiscal sovereignty. IMF data shows the trend in plain sight. The dollar's share of global reserves has slipped from 64.7% in 2016 to just 57.4% by late 2024. This wasn't a tremor. It was a tectonic shift, a message from the world's second-largest economy. U.S. Treasuries are no longer sacred. They are liabilities. And as China stepped back, the U.S. stumbled forward into a liquidity trap of its own making. Treasury officials began the quarter expecting nearly $1 trillion in cash. What they had instead was a gaping hole. Only $46 billion remained in the till. The debt ceiling, reinstated earlier in January, tightened the noose, and the government was forced into emergency borrowing just to avoid a full-blown funding crisis. Treasury's own admission. If the cash buffer hadn't vanished, it would have needed $53 billion less. Yet, they clung to projections that no longer made sense. Wall Street was bracing for $255 billion in borrowing. What they got was double that. And if Treasury misjudged this badly, what other blind spots are baked into the system? There was hope, at least among a few policy optimists, that Trump-era tariffs might plug the fiscal hole by pumping up customs revenue. But that theory is already faltering. Apple reported a $900 million tariff-related hit in Q2 2025 alone, and the fallout sparked internal debates about raising prices on the next iPhone. Meanwhile, consumer inflation surged from 2.2% to 3.4%. Driven by skyrocketing import costs. This isn't a fleeting side effect, it's structural. Imports are dropping, corporate margins are thinning, and tax receipts are struggling to keep up with the exploding interest payments on America's ballooning debt. The result? A nation trapped between economic overreach and fiscal reality, funding geopolitical strategy with borrowed time and borrowed money. For decades, U.S. Treasuries were the world's safe haven, the financial bedrock of the global economy. But now, in a world where the biggest buyer has walked away and the cash reserves are running dry, even that bedrock is starting to crack. The question isn't whether something has changed, it's how long until everything does. They said tariffs would bring balance, that they'd rebuild the foundation, that tightening the screws on trade would stabilize America's financial trajectory. But what the numbers now reveal is not restoration, it's constriction. A tightening fiscal noose, drawn tighter with every policy misfire, every bond auction, every yield spike. And behind each of those auctions isn't just an institutional buyer. It's a family, now paying more and getting less. With China walking away from the U.S. debt markets, the shockwaves are no longer distant or delayed. They are immediate, palpable. By May 2025, 10-year Treasury yields had surged past 6%. Mortgage rates shot up in tandem, reaching 7.8%, the highest in 15 years. That number isn't just data. It's fewer keys exchanged, fewer homes bought, Fewer dreams realized. According to Freddie Mac, auto loans have now breached 9.1%, while student loan rates average 6.6%. And what that means is simple. Credit is no longer a bridge to the future. It's becoming a barricade. Affordability is eroding not at the edges, but across the board. The Consumer Price Index climbed 3.4% in Q1, up from 2.2% the quarter before, led by surging food and energy prices. That's not friction, it's compression. The kind that squeezes a household's capacity to live, save, or plan. Bloomberg reports that household purchasing power declined 5.1% year over year. That drop isn't spread evenly. It hits the middle class with precision. Essentials, once affordable, are now inflated by a weakening dollar, down 9% since Beijing's exit began. The costs aren't just rising, they're compounding. And yet this is only the surface. Beneath it lies a deeper fault line, geopolitical confidence. The retreat of China is now mirrored by allies moving in quiet caution. In just the first quarter of 2025, foreign investors pulled $317 billion out of U.S. assets. That's the sharpest capital exodus since 2016, according to Treasury figures. Saudi Arabia, long among the top 10 holders of U.S. debt, has scaled back its holdings to $126.4 billion, a 22% drop in under a year. At the same time, Congress has ramped up pressure on American asset managers. A bipartisan directive forced BlackRock and Vanguard to divest $812 billion from 220 Chinese firms, injecting politics into capital flows at a scale rarely seen. The impact. Asian IPOs on U.S. exchanges collapsed. Where 75% of Asia-based companies once chose New York, just 28% did in 2025. Instead, Tokyo and Frankfurt are experiencing a golden era of listings and liquidity. The U.S. isn't just losing capital, it's losing its place in the financial order. What's unraveling isn't investor sentiment, it's trust. And while Washington tries to spend its way out, Beijing is building something else entirely. An exit strategy, systemic, structural, and permanent. In 2026, China will launch its own national credit rating system, cutting out Moody's, S&P, and Fitch. According to the China Institute of Finance and Industry, those agencies have cost Chinese state-owned enterprises up to 120 basis points in extra interest, despite strong balance sheets. That's not just economic strategy, it's sovereignty, enforced through finance. But China's ambitions don't stop with ratings. It's redesigning its payment architecture too. A domestic cross-border system that bypasses SWIFT, removing U.S. leverage in the event of sanctions or financial warfare. In parallel, BRICS Pay processed $56.4 billion in Q1 of 2025 alone, nearly half of it outside the dollar system. Bloomberg confirms this isn't a test run, it's a new global plumbing. These aren't marginal shifts, they're fundamental redesigns of how money, credit, and power move. And as this new infrastructure scales, the question grows louder. Does the US dollar remain the world's currency? Or is it quietly being downgraded to a regional role, propped up by nostalgia rather than necessity? Meanwhile, the US Treasury has rolled out a revised borrowing plan. $514 billion for Q2, $554 billion projected for Q3. These numbers aim to rebuild a federal cash balance of $850 billion. But as of mid-May, reality is far behind. Only $563 billion on hand, up from $46 billion in March, but still 33% below target. JP Morgan warns that assuming a smooth debt ceiling resolution is a fading fantasy. The market may soon lose patience with Washington's widening disconnect between fiscal ambition and cash-on-hand truth. Rating agencies are watching closely. Luan at IAPS has flagged the current Treasury cash strategy as unsustainable without swift congressional action. And as BRICS accelerates its financial independence, as China unwinds dollar exposure, even U.S. allies are now hedging against the risk of future instability. The message is clear. The post-war financial order is no longer unquestioned. It's under review, under pressure, under replacement. So the U.S. finds itself staring down a binary choice. It can reform, radically, or continue to drift, hoping that legacy status alone will carry the weight of global trust. But the world isn't waiting. Mortgages are rising, capital is fleeing, allies are hedging, and the center of global finance is shifting eastward, not by accident, not by force, but by deliberate design. And that leads to the question no one in Washington wants to ask aloud. What happens if the next Treasury auction underperforms? What if safe haven becomes systemic risk? What if the very instruments of American power, its bonds, its currency, its credibility begin to lose their aura? Drop your thoughts in the comments. Because what's coming isn't gradual. It's accelerating. Interest rate shocks, capital realignment, currency decoupling. These aren't hypotheticals. They're live signals. And the decisions made in the months ahead will echo for a generation. If you want to stay ahead of those decisions, subscribe now. Hit the bell, because we are tracking not just a shift in economic policy, but the slow-motion re-engineering of global finance. This isn't the end of the story, but it may be the end of the chapter where America called all the shots.